Hey guys, I told you I just changed my portfolio a little bit, and I told you that a couple of them I didn't know what the hell they did. Um, EOP is basically another energy. It's got 4,000 employees. Shit, I didn't mean to do that. So anyway, here's the basic numbers. PE 13. Earnings per share is positive. They pay a little bit of dividend, not very much. Um, but I just want to show you this is FinViz, and I found these through a screener. But I mean, the price to book is at 0.12. The PE here is 10. Forward PE. The current PE says 2.3. I mean, this looks cheap to me. It's not at a 52-week high or a 52-week low. Um, I mean, maybe I should have bought it in February. I mean, in January. Looks like it's gained $1.25 since then. But anyway, I just did a screener, and now all of these are perfect. No stock is ever going to be perfect. I mean, this one doesn't have a PE. The earnings is negative. Says they paying a dividend, but how are they paying a dividend if they got no earnings? And it's down quite a bit. But I was going to show you Guru Focus. Um, I did look up a couple of these, but then this thing popped up. And I don't pay for any services or nothing. You could get a free trial or whatever, but I just look at multiple things, multiple valuations and statistics and stuff. And to me, the enterprise value is basically what they think the company is worth, and the market cap is what the stock market thinks is worth. So if it's really worth 7.4 billion and it's only trading at 5 billion, it's cheap. And this price to book has it much higher at 1.22, whereas down here they got it at 0.12. So I don't know if that's a typo. I really have not spent much time looking at it. To me, they just look cheap. This one, It's probably nearing a 52-week high, but the P/E ratio is low. It's got positive earnings. There's no dividend that this says. It's kind of funny to read not read, but look at some of these articles. The worst performing utility stock in 2024. Is this one the worst? Strong net income. But usually when they write something like this, that's usually a signal, a buy signal for me. Because now this one says is one of the best ones to buy. But you know, when I had bought DAC, it was the worst. According to analysts, it was the worst thing you could possibly buy. Not only for that year, but for the previous 5 years, it was the worst stock in the entire world to buy. And I bought it. And I also like to, of course, I'm going to put somebody on the spot now. I also like to read the comments. But a lot of these comments are just pumpers and dumpers. But there are some very smart people. There are some very wealthy individuals that also comment on some of these things too. So you kind of gotta take it with a grain of salt. Probably 90% of the comments are just going to be trash, pumpers and dumpers, idiots, morons. And then you got probably 10% that are real serious investors. A great dividend stock, top dividend stock per your portfolio. Upgrade to buy, what you should know. A cheap bank stock. We didn't see P ratio 4, earnings per share $8. Dividend yield is 7%, which is really good. Some of the other ones didn't really pay a dividend, or if they do, it's very small. But stocks like this kind of make up for it. And I really don't like stocks that are this expensive, $30. I kind of like the sub $10 ones more, but now this one, the earnings per share is negative. There's no PE. It does pay a dividend, even though it's not making any money. The worst performing large cap stock to buy, according to analysts. Is Sue's undervalued right now? But I mean, they got the enterprise value at $26 billion and it's trading at 11. Really undervalued here. Cement, you already know I like cement. Earnings per share positive, PE under 10. A very, very small dividend, but a dividend nonetheless. Recognized one of the world's most ethical companies. Well, that's nice. And the stock recently got downgraded. BP, a well-known name. The P ratio here looks terrible. They do have a dividend. The chief takes more than a $2 million pay cut after slump in profit. But what I like about BP was they said something like they're not going to be as focused on like the Green New Deal, and they're going to be more focused on profits and profitability. That's what I want to hear. And they do pay almost a 6% dividend. And they got 100,000 employees. So every night when you go to sleep, if you own one share of BP stock, know you got 100,000 people working for you day and night. Well, not day and night, but you got 100,000 people working for you. And hopefully those 100,000 people can be profitable and make a product that makes money and makes you money. So yeah, some of these I just think that they're cheap. You know, I'm not going to be right on all of them probably. Maybe I'm going to be wrong in a couple, but that's why I'm only putting 5% instead of 10 or 20%. But almost every one of these, I try to find something that I find to be cheap, and others agree with me that it's undervalued, that it's cheap. You know, all I got to do is scroll right here and a cheap bank stock. So their screener, they did forward PE of 15 with positive earnings growth, and analyze upside potential of at least 25%. Next, we cross-check the forward PE for each stock from Seeking Alpha, earnings growth from Yahoo Finance, and analyst upside potential from CNN. Lastly, rank the stocks in ascending order of the analyst upside potential. Blah, blah, blah. I mean, me personally, I really don't care what the analysts say. I really don't care what they think. But it's kind of nice that when I do my own research, when I pick my own stocks, and then I go down and all there is articles saying strong net income. Is this thing undervalued? This thing is the worst thing possible to invest in. Best penny stock. So I like it just kind of tells me, hey, I'm on the right track. Should value investors buy blah, blah, blah? You know, worst performing, blah, you know, this one's undervalued. So I don't read these things first. I do my own research, my own analysis. I want to know, is this thing, all right, is this like a top 20 company in the world? Is this fair value? Because if it's fair value and you get a top 20 company in the world, yeah, I don't mind paying fair value for it. But to me, there's not that many top 20 companies in the world that are on sale or cheap. I mean, you could argue a couple years ago when COVID happened, when Facebook went down, or what is Meta now, it went down like 80% or something. That was the time to buy. I don't particularly like Facebook. I don't even know how they make any money. Like, somehow they sell your information to advertisers, and then they somehow make money back by putting advertisements up that you might want to buy. I really don't understand how they make money. And I don't need to understand every single business. I mean, a long time ago, there was something called MySpace, and I think MySpace was better than Facebook. And then, I don't know what happened to MySpace, but MySpace went away, and Facebook started making billions and billions of dollars. But I don't know how they do it. I don't really understand it, to be honest with you. So sticks out as one of the market's strongest value stocks. We've already talked about this one. We've talked a little about BP. But yeah, I don't really trust one particular site in over others. But as a whole, when you go to 3 or 4 different sites and they all think it's cheap, they all think it's undervalued. There's a good chance that it might be undervalued. And just because something is undervalued doesn't necessarily make it a good stock to buy, because their earnings could be diminishing. They could be eating away their cash. They could be making bad investments. Maybe they got a new competitor that's eating away at their profit margins. Maybe it's a declining business, or maybe one of their big suppliers is going bankrupt. There's a lot of different things to consider, and but me personally, I do a screener, and whatever something pops out at me, sometimes I'll put it on my radar, put it on my back burner, and then when I see the name pop up again, I'm familiar with it because I've researched that company before in the past. But you got to use screeners, because no one person could possibly analyze 60,000 or 100,000 individual companies on a day-to-day basis. So you got to rely on your screeners, a good screening method to give you a sizable pool. I mean, you don't want to look through 500 pages of companies. So you got to have, and like, I really don't like banks that much. Even though I did pick a bank, but I want companies to actually make something. You make a widget, or you sell a tree, or you sell cement, or you sell gas, or you sell oil, or maybe you make soybeans, or you sell, something that you can see tangibly with your hands, and you got employees, and you got real earnings, and so I know some of these companies, like this one, definitely does not look good with a negative $3 in earnings. But we'll see what happens. We'll see what happens. And give it some time. Give it a year or two, and we'll see if I was right or wrong. But anyway, thanks for letting me share, guys. Good luck to you guys. And hopefully I'll be back saving money. Hopefully I'll get caught up here soon, and I'll be back to investing as soon as I can. And again, if someone wants to give me a check tomorrow for $1 million, I'll be your one and only client. I mean, you'll be my one and only client, and we'll get it rolling. And hopefully we'll turn that $1 million into 25 or 26 million in the next 10 to 15 years, and maybe I could quit my day job and just focus on making you money all the time. But yeah, that's one thing I would like to do, is start my own business, start my own fund. I believe I can do better than the industry leaders. I don't have a proven track record. I don't have the clientele that believes in me, that's willing to, hey, here's $1 million, or here's $100,000. Here, throw it at those damn penny stocks you be looking at. Throw it at those companies that they say is the worst to possibly invest in. But if something is very undervalued, even if they lose money, even if the company goes bankrupt, you could sell the assets or sell the cash, or you wouldn't have to sell the cash, you'd have the cash. But sometimes they got more cash than the business is worth. Sometimes the plant, property, and equipment are, they bought it 30 years ago, and now that land, property, and equipment is worth a lot more than what it's saying it's worth on the balance sheet. Like in the case of DAC, for example, they had ownership in other businesses, and those other businesses took off. So sometimes this investment is in other businesses. You don't even need a successful business yourself if you have investments in other businesses that are successful. I mean, well, Warren Buffett had 5% of Apple or 6% of Apple at one point, and that was the number one stock for a long time. But anyway, guys, thanks for letting me share. There's just no rhyme or reason behind why I picked these. It's just, hey, I just needed a couple of stocks to fill in some holes, and I'm selling. I sold one that did well. I sold that banana company, but I also sold one that I did poorly in. So I kind of needed to balance it out a little bit. Maybe I should have kept the banana company. I forgot the name of it. It was not Dole. I forgot the name of it. But if you looked at the graph, it was basically like a solid line over the last 20 years. Now, if you're making a profit and you're reinvesting in more assets, if you're Coca-Cola or something, or Pepsi, you're buying, I'm just making up stuff. I'm just saying, let's say one year maybe you buy Doritos, and the next year you buy Fritos, and the next year you buy some kind of pizza chip, or Lay's or whatever, or Snickers, or every year you're buying more and more assets. So as time moves on, 20, 30, 40 years down the road, you just don't have you just don't sell Coke, or you just don't sell Pepsi, but you have ownership in all these other businesses, all these other brands. I mean, when you go to the grocery store, there's a lot of groceries that maybe just one or two or three companies make, and maybe that brand is famous for coffee, but they also maybe they sell sugar or napkins or something. You know, like they diversify. They find a profitable business model, but then they buy other assets that complement that business model. Or at least you hope they make smart decisions. But so no stock should be flat for the last 20 years, especially if they're profitable, because over those 20 or 30 years, they're buying assets, they're buying more assets. Like the one company I like that I have not invested in recently, but and it's not available to, but they've bought assets and assets and assets and assets and yeah, those assets have not turned into profits yet, but they're buying assets so that 2 years, 3 years, 4 years down the road that they'll be making more money. And not only that, they dominate a region. You want companies that dominate a region. That's how Walmart got started. But when they got killed was when they tried to go overseas, because they don't dominate a region overseas. They can dominate a local region. They got the infrastructure and they got the logistics set up, and they got the the trucks and the holding warehouse stations where they can ship out stuff to all the regional stores in that region. But when you go overseas and you're competing against another language and another culture, and you are not the dominant force. Anyway, thanks for letting me share, guys.